Hey guys, today we are going to be discussing the concept of liquidity. So let's dive right in. So in today's study, we are going to be defining the term liquidity. We are also going to be talking about the different types of liquidity, and we are going to dive into swing points and other forms of liquidity. And then there is an assignment at the end of the whole study. Okay, so grab your note, your pen, and let's dive. Let's dive right in. So first, what is liquidity? Right. Liquidity simply means money in the market, right? Liquidity simply means money in the market. It is no news that money is the wheel of the financial markets, right? And when I'm talking about financial markets, I'm talking about the forex market, the index futures market, the indices, the crypto market, the stocks, right? And other types of financial markets, right? Money is the wheel of the financial markets. Now, this money is what we are referring to as liquidity. Okay, so it's not something superstitious. It just simply means money in the market, right? That is the simplest definition of liquidity. Okay, so we have two types of liquidity, two major types of liquidity, which include the buy side liquidity. These are liquidities resting above an old high. Okay, so these are liquidities resting above old highs. And we have the sell side liquidity, and these are liquidities resting below an old low. These are liquidities resting below old lows. Okay. But you see, to understand what a low and a high is, we need to understand and examine what swing points are, because they play key major role in defining what an old high and an old low is. Okay. So let's dive right into that. So there are two major types of swing points, right? Which are a swing low, right? A swing low. This is simply a low with two lows to the sides, right? Which are higher than the marked low. Okay, so there are two lows to the sides of this marked low, and these two lows to the sides are much higher than the marked low. So we call that a swing low. And if you look to your left, you're going to see a pictorial view of what a swing low is. Okay, so you can see these two candlesticks to the left and to the right, much higher than the one at the middle. This candle at the middle's low is what we mark out as a swing low. All right, so a swing high also is simply a high with two highs to the side, which are lower than the marked high. Okay, so we have these two candles to the sides with their highs lower than the marked high. The candle in the middle, the candle in the middle's high is what we mark out as a swing high. So with this understanding now, right, we can now look at videos where I highlighted buy side and sell side liquidities, and I used the replay tool on TradingView to show how markets gravitates towards those types of liquidities. So we have in the first video here, we have the sell side liquidity, right? Resting below this old low. Now you can see price comes back and smacks that low, right? So why this is important is because everybody who went long in these markets had their stop losses below this low. And as price came back and took out this low, swept this low, what market basically just did was market came and swept liquidity. All that money resting below that this low has been taken by the market. Okay, so let's watch that clip again. Right, so we have this low. You can see the swing low was marked out here, and that swing low is where the sell side liquidities we are resting. Okay, so you can go to your chart and mark out different examples like these as well. So let's see a video depicting buy side liquidity. Okay, so we have this swing high marked out, and we are going to see how the market gravitates towards that high and ends up taking out all the monies resting above these highs, right? So everyone who went short in this market had their stop losses resting above these highs. And when we say market has swept an old high, what we're basically saying is the market has taken liquidities resting above these old highs. All right, so we're going to watch that clip again for for another view of what we're talking about. So these swing highs, you can see the candles to the left or to the right much lower than the one in the middle, which I marked out there, right? So this is a picture of what buy side liquidity looks like in the market. So go to your charts and mark out old highs and old lows and play out and watch out to see how price gravitates towards these highs and lows, right? So now you understand what buy side and sell side liquidities are all about. Let's discuss other forms of liquidity. Okay, so we have other forms of liquidity, right? To dive deeper into the concept of liquidity, we will discuss other forms of liquidity, which include time-based liquidity. This form of liquidity is liquidity resting above or below the high or low at different times. Okay, so it is time-based, as the name implies. So we have in this form of liquidities, we have the daily highs and lows. Example, Monday, Tuesday, right? We have weekly highs and lows. Week 1, week 2, week 3, week 4 of the month, right? We have monthly highs and lows, January, February, March. We have quarterly highs and lows, Q1, Q2, Q3, Q4. Okay, so Q1, we have January, February, March, and all of that good stuff. Then we have the session highs and lows, which includes Asian, London, the New York AM, and the New York PM session highs and lows. All right, so you can easily mark out these daily highs and lows on the daily time frame, the weekly highs and lows on the weekly time frame, the monthly highs and lows on the monthly time frame, right? And you can watch how price eventually gravitates towards these highs and lows to take out buy side liquidities and sell side liquidities relatively. All right, so that is it for time based liquidities. Okay, so we have other forms of liquidity. We have the trend line liquidity. As the name implies, it is a form of liquidity that forms when the market forms a series of lows or highs in a trend line manner, in a trend like manner. Okay, so we see that this trend line liquidity most times often offers low resistance liquidity runs. Okay, so when we see market putting on series of highs like this, if you look at the image to your left, the trend line price and liquidity, you could see price putting up series of highs, and you see sellers going short at every point the market touches that trend line, right? And the market leaves and keeps on putting up this trend line signature. And at some point, price reverses and takes out all the resting stop losses and monies above these highs, right? So we refer to this as a trend line buy side liquidity, which most times offers low resistance liquidity runs. Okay, so we have that also for the sell side liquidity part, where we see price putting on series of lows, right? As price keeps gravitating sluggishly towards that high, and then all of a sudden price smacks down, takes out all the resting lows, resting all the resting sell side liquidities resting below these lows, right? Price comes back, takes them out, right? And this offers a low resistance liquidity run as well for the trend line sell side liquidity. Okay, so we have relatively equal highs, right? This is a form of liquidity that is formed when the market creates relatively equal highs as a form of buy side liquidity. Okay, this to me is the strongest form of liquidity when paired with time. Yeah, this is the strongest form of liquidity when you pair it with time. Okay, so we have the image to your left. You can see how price puts up. People call it double top. Okay, so that double top creates a relatively equal high liquidity, and price will often gravitate towards that relatively equal highs to take out the buy side liquidity is resting above those highs. And the same thing for relatively equal lows, right? We have this double bottom here, and then price comes back, smacks through these lows, takes out all the sell side liquidities resting below these lows. All right. So now we have understanding of what trend line with relatively equal highs and relatively equal lows liquidities are. Let's move forward to a video where we could see the, that in play, right? So once again, I'm using the trading view replay tool to offer this study. Okay, so you could see this trend line liquidity forming at these lows, right? Market keeps bouncing off this trend line, and at some point it sucks in a lot of buyers who come into the market looking to buy as price retraces down to this trend line point. And at some point, price right reverses and takes out all that sell side liquidities resting below these lows. Okay, so this offers what we call low resistance liquidity runs. So what that means is that, as you will see, when price was gravitating towards taking out these liquidities, it offered little to no resistance in its movement. It was more like um a an easy route. Okay, it was not so difficult. Look at this push up. It was so difficult to push higher, right? So this is a high resistance liquidity run. Okay, then when price reversed to take out all these sell side liquidities resting below these lows, we call that a low resistance liquidity run. Okay, so this is an example of a trendline liquidity. So we're going to go over that video again so you understand that. Pay attention to how price comes back to take out those lows, right? So this is a trendline liquidity, right? And this is how price comes back to take out those lows. Okay, there. All the stop losses and the monies resting below these lows have been smacked by price. Okay, so let's go back to the next video. After price took out this sell side liquidity, right? This low resistance liquidity run that was formed when price put up this trend line liquidity pattern. Okay, we have we have to the highs, we have a low resistance liquidity run as well, with price putting on these relatively equal highs, right? And we are going to watch and see how price eventually gravitates towards these highs, right? Subsequently. Okay, so pay attention to the video, right? So we have this buy side liquidities resting above these highs, right? Okay, now, so let's watch and see how price eventually, right, gravitates towards these highs. Okay, this is what happens in the market every single time. The market is seeking to do two things all the time: to take out buy side and sell side liquidities resting below old highs and old lows, and to fill up gaps. That is all the market does every day. So when you view price from that lens, your read of price gets easier, and you begin to get acquainted with price action. Okay, so you can see price eventually gravitates towards that high, sweeps out that relatively equal highs, right? Offering little to no resistance as price moved higher. Okay, so This is a picture example of what a relatively equal high is and how price gravitates towards this form of liquidity. Okay, so our next video, we're going to be seeing relatively equal lows, right? How price comes back to smack relatively equal lows. Like I said, the relatively equal highs and lows are like magnets to price, right? And now um I'm borrowing ICT's comment on that as well, right? So they are like magnets to price, right? So whenever you see relatively equal high and low or low, there is high chances that the market is going to eventually gravitate towards that high or low. Okay. Whenever I'm on a trade, right, I like to set my targets towards a relatively equal high or a relatively equal low, right? That will offer me a higher chance of price meeting my target. Okay. So if you go to your Euro USD chart of this week, right? This video is made on the 1st of November 2025. So if you go back, if you're watching this ahead of this date, you can go back to this week's price action and you can see how price gravitated towards a relatively equal low that was set in on the Euro USD, and you could see how price virtually gravitated towards that. So you could see price smacked below that low, those relatively equal lows, and then I marked the opposing high, right? And price eventually gravitates towards that. What's resting below this high? Correct. Buy side liquidity, right? Price gravitates higher, smacks through that high, grabbing all the liquidity resting above that high. Okay. Yeah. Okay. So let's move forward. In summary, the concept of liquidity is a key concept in trading, and as such demands hard work and diligence in its study and understanding. This is important because every key swing low or swing high formed in the market was formed after price swept the buy side or sell side liquidity resting above or below the highs or lows of the market before moving to the market's draw on liquidity. What this basically means is that before price put on a major move, right, either higher or lower, as we've seen in the previous videos, you will see that before price put on a major move higher or lower, price always seek to take out liquidity, either buy side or sell side, depending on the direction the market is aiming to move. Okay, so if you are bearish on the day, you want to mark out highs, right? You want to mark out highs that you expect price to take out what is resting below above those highs, buy side liquidities. So you want to mark out buy side liquidities that the market is going to eventually take out before sending price lower. Okay, this is for a reversal trade, right? So if you're in the market and the market is has been bullish all day and you're expecting a reversal on that day, what you want to see the market do is market take out an opposing liquidity. So if you are bearish, you want market to take out a high, sweep the liquidity written above those highs, and then eventually start surging lower. Now, if you're looking for buys, you want price to take out liquidities resting below old lows, that is set side liquidities, before price begins to push higher. Okay, so that is how the market runs. Okay, so that is how the market runs, and because of this, traders are easily deceived into random lows and random highs getting swept, and then they position themselves either too early, right, into into the market and they end up getting their money taken, or they they read the market wrongly and take a trade against the market direction for the day. So I'm going to come again. Because of this concept of liquidity, the key reason why we have to understand the concept of liquidity is because every time the market is about to make a major move, for example, the market wants to trade higher, right? The market is going to seek sell side liquidities resting below old lows to take out all the monies resting below those lows before eventually pushing higher, right? Now, if market wants to, if the market is bearish on the day, right? That is, the market wants to push lower, wants to go lower today. What the market is going to do is the market is going to seek opposing liquidities, that is, liquidities resting above highs, which are buy side liquidities. The market is going to seek to take out those liquidities and then eventually push lower. So when price is gravitating towards those liquidities, what price is virtually doing is manipulating the market, manipulating traders. So we call that manipulation. And after that manipulation, we have distribution. So after price takes out for a bearish day, market takes out a buy side liquidity, right? After taking out that buy side liquidity, the market begins to push lower, right? And then for a bullish day, market will draw lower, take out sell side liquidities, and then begin to push higher, right? So you could see, right, in this video again, you could see what I'm talking about. So on this is the daily time frame, right? There are buy side liquidities resting above old highs, as you could see to at the top of this at the top of the market. At the top, you could see all these relatively equal highs, right, which holds buy side liquidities, right? But you see, the market will not just keep pushing higher to take out all those highs. The market could do it if it want to, but the ideal thing to expect in the market is that when the market is about to take out buy side liquidities, what it does is that it first of all take out opposing liquidities. So it takes out sell side liquidities resting below old lows, right? And then begins to gravitate towards that initial draw on liquidity it had on the day, right? So let's use for instance. Now we are bullish and we're expecting price to trade higher. But you see, we have these relatively equal lows resting below these lows here. And what the price do? Price begin to gravitate. This move lower is manipulation. This is pure manipulation, right? Now market has sucked in sellers, right? Who have who took this shot right here. And where would their stop losses be? Correct. Above these highs. And what are those liquid and what is this liquidity resting above this high called? Buy side liquidity. Okay, so price has virtual as taking out these lows, right? You could see another manipulating leg as well. These two bearish candlesticks put in by the market to further take out sell side liquidity. And then what happens? Price immediately reverses and takes out that buy side liquidity resting above that high. Okay, so this is what the market does every single day. Okay, every single day. So let us so you can go to your charts, right, and find examples like this for the bearish buyers. Okay, so that is how it is. That is just the basic thing you need to understand about liquidity. All right. Now, because of this, we need to know when is the right time. When is this sweep of liquidity valid? When is it valid? What should I? What is this? What signature do price put in to validate an accurate sweep of liquidity? The answer to that question to me is SMT, right? Once I see the market putting an SMT, right, I can immediately get comfortable and begin to expect reversals. And in the previous video I made, I talked about what validates an SMT. So if you understand this concept and you pair it with SMTs, right, and you pair it with time, you can begin to create your own model that will suit the kind of trader, the type of trader you want to become. Okay, so pairing the concept of liquidity with SMT will save you a lot of stop loss experiences. Okay, so it will increase your win rate, and if you can get discipline enough, you begin to gravitate towards profitability in the market as well. Okay, so no matter what you know technically, if you're not psychologically sound and disciplined in the market, you take 10 wins and give out all your 10 wins in 2 or 3 trades or 4 trades, or even if you spiral, you might even lose all your portfolio in one day because of multiple trades. Okay, so you don't want that to happen to you at all as a trader. All right, you want to pair whatever you think you've known as a technical concept, whatever you've modeled out as your own personal model. You want to pair that with your psychology and discipline in the market, or else you will keep hitting new highs and then eventually hitting major lows that will keep on draining your psychology, and you don't want that to happen to you as a trader. All right, so right at the end of this teaching is what I marked as a homework. Okay, so you go to your charts, mark out these forms of liquidity, right? I've listed all the forms of liquidity you should mark out on your charts here. And for the session liquidities, I've given you the time frame to look at, okay? The time range to look at for each session, okay? And I want you to mark out the highest highs and the lowest lows within this specific time range of the session. So ignore every other high if they're not there. If that high is not the highest high formed in that session, is irrelevant. The only relevant highs are the highest highs formed within that session. Okay, so I want you to go there, marking them out. I want you to pay attention to how price gravitates towards these forms of liquidities that have been listed here. This will help you read price better, and you begin to see the market through a proper lens. Okay, so to go over what we've said already, liquidity is simply money. Okay, money is the wheel of the market, right? And we have different forms of liquidities. Okay, we have the buy side and sell side liquidity, which has the 2 major types, and then we have other forms of liquidities, which we discussed already. Okay, so you understanding this concept of liquidity, and you pairing it with the SMT concept, which we discussed in the last video, can set you towards the path of becoming profitable. And until our next class, stay safe, happy, and disciplined.